Gold has always been perceived as the ultimate safe haven. From ancient civilizations to modern investors, it has been the symbol of wealth, stability, and protection against economic uncertainty. But what if everything you've been told about gold is misleading? What if the price of gold that you see every day, the numbers flashing on screens, the charts analyzed by experts, is not the true reflection of its value? In this first part of our investigation, we will uncover the hidden forces that manipulate gold prices and reveal why the $6 trillion gold market is not what it seems. At first glance, gold appears straightforward. Investors buy it during crises, banks hold reserves, and nations maintain it as a hedge against currency volatility. Yet, beneath this veneer lies a complex web of financial engineering, derivatives, and shadow markets that distort the real supply and demand. The official gold price, often reported by financial news outlets, is influenced by mechanisms like the London Bullion Market Association, LBMA fixings, COMEX futures contracts, and major central bank operations. These mechanisms are not just technical, they are powerful levers through which a handful of institutions control the perception of gold's worth. The $6 trillion figure is staggering. That's the estimated total value of all gold holdings globally, including ETFs, central bank reserves, private investments, and unaccounted for hoards. But consider this. Much of this gold is not actually accessible for trading in the conventional sense. Central banks hold large portions in vaults. ETFs only represent claims rather than physical possession. And derivatives create artificial layers that can be traded multiple times over the same underlying gold. This means that the gold market is partially an illusion, a financial mirage where the numbers do not reflect the physical reality. Derivatives play a particularly sinister role in this illusion. Futures contracts allow investors to bet on the future price of gold without ever taking possession of a single ounce. These contracts can be layered upon each other, multiplying exposure far beyond the actual gold that exists. When large financial institutions execute massive trades in these paper markets, the price of gold can move dramatically even if physical supply and demand remain stable. For an everyday investor, this creates a false sense of market behavior. You might think the price is reacting to global events, inflation fears, or economic instability, but in reality, it could be driven entirely by the trading algorithms of a few major players. Central banks themselves are not innocent in this narrative. Institutions like the Federal Reserve, the European Central Bank, and the Bank of England have historically intervened in gold markets to maintain economic stability or control inflation expectations. By releasing or withholding gold, lending reserves, or engaging in swap agreements, central banks can influence the official price without any market participant fully understanding the moves behind the curtain. For instance, during periods of economic stress, central banks might suppress gold prices to maintain confidence in fiat currencies or prevent panic buying. As a result, gold can appear cheap, even when the underlying conditions suggest it should be rising. Another layer to this story is the role of gold ETFs, which have become a dominant force in the past 2 decades. Exchange-traded funds allow everyday investors to gain exposure to gold without ever touching a bar. While convenient, ETFs introduce a new form of abstraction. The price of an ETF share is supposed to track the value of gold it represents, but market dynamics, management strategies, and trading volumes can create discrepancies. In moments of extreme volatility, these discrepancies can widen, leaving investors believing gold is more or less valuable than it really is. The ETF structure adds liquidity, but also opacity, making it harder for ordinary people to grasp the true state of the gold market. Historical events provide additional clues that gold prices have been manipulated. Consider the 2008 financial crisis. Gold initially rose as a hedge, but large interventions by central banks and coordinated selling in the futures market temporarily suppressed prices. Similarly, in 2011, gold reached an all-time high, only to plunge dramatically afterward, despite ongoing global economic uncertainty. These swings were not solely based on supply and demand. They were heavily influenced by coordinated financial strategies behind closed doors. Such events raise a critical question. If gold truly reflects economic fundamentals, why is it so frequently subject to artificial swings? The implications of this manipulation are profound. For individual investors, following the official gold price without understanding the underlying mechanisms can lead to poor decisions. Buying gold at low prices during a suppressed market might seem smart, but if the market is artificially restrained, gains could be limited until the manipulation ends. Conversely, selling during a temporarily inflated price can lock in profits that never reflect the asset's long-term value. Beyond personal finance, these distortions affect global economies, as countries base reserves, trade strategies, and monetary policy on what may be misleading market signals. Perhaps most concerning is the secrecy that surrounds gold trading. Unlike equities, where companies disclose financials and regulators monitor activity closely, Much of gold trading occurs in private agreements, over-the-counter contracts, and centralized auctions with limited transparency. The opacity allows large institutions to operate without the scrutiny that public markets face, creating an environment ripe for manipulation. Insider knowledge, preferential access, and algorithmic trading further tip the scales, leaving everyday investors at a structural disadvantage. In conclusion, the $6 trillion gold market is far more complex and manipulated than it appears. Official prices do not always reflect physical supply, investor sentiment, or global economic fundamentals. Futures, derivatives, ETFs, and central bank interventions create an intricate illusion, giving the impression of a dynamic market while hiding the mechanisms controlling it. For those seeking security in gold, understanding these hidden forces is not optional. It is essential. As we move into part 2, we will explore the consequences of this manipulation, the geopolitical implications, and why the gold you own, or plan to buy, may be worth far less than the market suggests. As we dive deeper into the $6 trillion gold trap, it becomes evident that the manipulation of gold prices is not just a financial curiosity. It has profound consequences for the global economy. Gold, often considered a safe haven, is intricately linked to national reserves, currency stability, and investor confidence. When its value is distorted, the ripple effects can impact governments, corporations, and individuals alike. The consequences of this manipulation are not hypothetical. They are tangible, shaping fiscal policies, global trade, and even the future of financial systems. One of the primary mechanisms through which gold prices are manipulated is the futures market. Futures contracts, which allow traders to buy or sell gold at predetermined prices on future dates, have become a dominant force in shaping perception. While they provide liquidity and risk management tools, they also create artificial scarcity or oversupply in the market. Large institutional traders can coordinate massive positions, influencing prices without any actual movement of physical gold. This is particularly effective because the majority of gold trades today are paper gold rather than actual bullion. A single ounce of gold can be represented multiple times in these contracts, inflating its apparent supply and creating a false sense of market balance. The shadow of central banks looms large over this system. Institutions like the U.S. Federal Reserve, the European Central Bank, and the Bank of England have historically intervened in gold markets to stabilize currencies or maintain economic confidence. During periods of crisis, central banks may release gold from reserves to control price spikes or use swap lines to manage liquidity. These interventions are rarely transparent, leaving markets to speculate about their scale and impact. For example, coordinated sales of gold during economic uncertainty can temporarily depress prices, masking the true demand from investors and nations alike. The ability of central banks to influence the market means that no matter how informed an individual investor believes they are still competing against powerful actors operating behind closed doors. Derivatives further complicate the picture. Beyond futures, swaps, options, and other complex financial instruments allow institutions to hedge, speculate, and leverage positions on gold without ever touching the metal. These tools amplify market movements, often in ways that are disconnected from physical reality. For instance, a surge in speculative derivatives can drive prices higher, even if global demand for actual bullion remains steady. Conversely, coordinated derivative sell-offs can depress prices despite ongoing geopolitical instability or inflationary pressures. This decoupling between the paper market and the physical market is a central reason why gold prices often appear erratic, confusing ordinary investors who rely on headline figures for decision-making. ETFs, exchange-traded funds, have democratized access to gold, but they also add layers of opacity. While ETFs promise exposure to physical gold, the shares themselves are often traded far more actively than the underlying bullion. This creates discrepancies, especially in times of market stress. A sudden surge in ETF redemptions or purchases can push prices up or down, independent of physical supply. Investors, thinking they are participating in a transparent market, are often reacting to signals generated by abstract financial constructs rather than the actual movement of gold. In essence, ETFs can amplify the illusions created by futures and derivatives, making it even harder for everyday investors to discern reality from perception. Geopolitical events, which historically drove gold prices, are increasingly filtered through these financial mechanisms. Take, for example, sanctions on major economies, wars, or political instability. While such events should naturally drive gold prices higher as a safe haven asset, the impact can be muted or exaggerated by financial engineering. Coordinated interventions, speculative trading, and derivative leverage can override the natural market response. This creates an environment where the official gold price is not a reflection of risk, but a reflection of the strategies employed by a few dominant financial actors. Investors relying on gold as a hedge may find that their protection is illusory, vulnerable to the hidden currents of manipulated markets. The consequences of this manipulation extend beyond individual investors to entire nations. Countries with substantial gold reserves rely on their valuation to back currency stability and maintain international trade credibility. When gold prices are artificially suppressed, a country's apparent wealth is reduced, potentially affecting credit ratings, borrowing costs, and geopolitical influence. Conversely, sudden spikes in gold prices can trigger inflationary fears, prompting central banks to adjust interest rates or intervene in foreign exchange markets. The ability of a small group of institutions to influence these outcomes represents an extraordinary concentration of power, one that most policymakers and investors underestimate. Moreover, the psychological impact of gold price manipulation is profound. Gold is not just a commodity, it is a symbol of security, a cultural and financial anchor. When investors see prices fluctuate wildly without clear reason, confidence can erode. Retail investors, pension funds, and even sovereign wealth funds may hesitate to commit resources, fearing that the market is rigged. This erosion of trust has broader implications. When confidence in a supposedly stable asset is undermined, it can trigger wider market instability, reduce investment in other sectors, and amplify economic volatility. Technology and algorithmic trading have added a new dimension to this manipulation. High-frequency trading systems can react in milliseconds, executing thousands of trades in ways that humans cannot track. These systems are often programmed to follow patterns, trigger stop-loss orders, or exploit minor market anomalies. In the context of gold, algorithmic trading can exaggerate price swings, creating panic or euphoria artificially. Ordinary investors, unaware of these mechanisms, may make decisions based on apparent trends that are engineered rather than organic. The result is a market that is simultaneously hyper-efficient and dangerously misleading. International tensions further expose the fragility of perceived gold stability. Emerging economies, particularly those under U.S. sanctions or experiencing currency crises, often turn to gold as a hedge. Yet, when global institutions manipulate prices, these countries face additional challenges. They may be forced to sell reserves at depressed prices or delay strategic acquisitions, limiting their economic sovereignty. This is not a theoretical scenario. History is replete with examples where political and financial pressures intersected with gold market manipulation, shaping national destinies. In conclusion, the $6 trillion gold market is controlled by forces that ordinary investors, and even many governments, struggle to comprehend. Futures, derivatives, ETFs, central bank interventions, algorithmic trading, and geopolitical strategies all intersect to create a price that often lies about reality. Gold, while still a valuable asset, is no longer a purely natural reflection of supply, demand, or economic risk. In Part 3, we will examine how to navigate this treacherous landscape, identify strategies to protect wealth, and uncover the deeper geopolitical shifts that are being influenced by this hidden $6 trillion game. We will also provide actionable insights on how ordinary investors can safeguard themselves from the illusions created by the gold market and make informed decisions despite its inherent opacity. Having explored the hidden manipulations of the gold market and the global consequences in Parts 1 and 2, it's now crucial to discuss what investors, nations, and individuals can do in this increasingly complex landscape. The $6 trillion gold market is far from transparent, and understanding the forces at play is essential for making informed financial decisions. Whether you are an individual investor looking to protect your savings, a portfolio manager trying to hedge risk, or government navigating international reserves, recognizing the layers of manipulation is the first step towards safeguarding wealth. The first key strategy is understanding the distinction between physical and paper gold. Physical gold, bars, coins, and allocated bullion stored in secure vaults, represents the only tangible asset in this market. While ETFs, futures contracts, and derivatives offer liquidity and convenience, they carry inherent risk because their value can be influenced by market manipulation, leverage, and algorithmic trading. Owning physical gold ensures that you possess the actual asset, independent of financial engineering or market perception. This doesn't mean paper gold is inherently bad, but it must be approached with awareness of the underlying risks. Diversification is another critical principle in navigating this market. Relying solely on gold as a hedge against economic instability can be dangerous if you do not account for its manipulated pricing. Investors should consider a combination of physical gold, equities in gold mining companies, and alternative assets such as silver or platinum. Each component has its own risk profile, liquidity characteristics, and market drivers. By diversifying, you reduce exposure to artificial swings in any single market and increase resilience against the hidden forces influencing gold prices. Monitoring market signals beyond headline gold prices is equally important. For example, tracking central bank movements, changes in ETF holdings, and shifts in futures, market positions can provide insight into underlying trends that are not immediately visible in the official price. Similarly, geopolitical developments, international trade tensions, and currency fluctuations often foreshadow gold market movements that are not yet reflected in the paper market. Staying informed through multiple sources, financial reports, central bank statements, and independent market analysis helps investors identify discrepancies between perceived value and actual market conditions. Risk management strategies are also vital. This includes setting stop-loss orders, avoiding excessive leverage, and maintaining a clear plan for both gains and losses. Over-reliance on short-term price trends in a manipulated market can result in significant losses, particularly for retail investors. Gold, while historically resilient, is not immune to engineered volatility. Understanding the potential for sudden price corrections or market interventions allows investors to protect capital and avoid emotional decision-making during periods of uncertainty. For nations and institutions, the implications of gold manipulation are even more profound. Countries holding substantial reserves must account for the possibility that official prices do not reflect real-world value. Decisions regarding currency stability, debt management, and international trade can be affected by misrepresented gold prices. Policymakers need to integrate intelligence on global market manipulation, monitor central bank activities, and diversify reserves to mitigate the influence of distorted prices. Failure to do so can undermine economic sovereignty and national financial security. Transparency is another cornerstone of protecting wealth in this environment. Investors should seek custodians and brokers with clear reporting standards, reputable audit practices, and verified holdings. Avoid intermediaries that obscure ownership or rely heavily on paper-based instruments without disclosure. The more visibility you have into the actual movement of your assets, the better you can respond to market manipulations rather than being a passive participant in someone else's OES strategy. Education plays a critical role as well. Understanding the historical patterns of gold manipulation, the mechanics of futures and derivatives, and the role of central banks provides a framework for making informed decisions. Without this knowledge, even experienced investors can be caught off guard by sudden price swings or market anomalies. The financial world is increasingly complex, and gold, despite its long-standing reputation as a safe haven, is not immune to engineered volatility. Knowledge is therefore one of the most powerful tools for survival in the $6 trillion trap. Geopolitical awareness also intersects with gold strategy. Emerging economies often rely on gold as a hedge against dollar dependency or inflation. In contrast, major powers may engage in strategies to suppress gold prices to maintain currency dominance. Understanding the interplay between nations, sanctions, and international monetary policy can provide critical insight into market trends that are otherwise invisible to retail investors. This geopolitical lens allows both individuals and institutions to anticipate market disruptions and act proactively rather than reactively. It is also worth noting that technology and algorithmic trading will continue to evolve, creating new opportunities and challenges in the gold market. High-frequency trading can magnify price movements within seconds, making short-term volatility extreme and often disconnected from physical fundamentals. Investors must adapt by focusing on long-term strategies, physical holdings, and diversified portfolios, rather than attempting to time manipulated short-term price fluctuations. The key is patience, discipline, and awareness of the structural forces at work. Finally, understanding the psychological dimension is crucial. Gold has historically been a source of trust in uncertain times, but the perception of stability can be deceptive. Manipulated prices can create false confidence or panic, influencing decisions based more on perception than reality. Remaining objective, informed, and disciplined is essential for navigating the market successfully. By combining physical holdings, diversification, risk management, transparency, education, and geopolitical awareness, investors can mitigate the dangers of the $6 trillion gold trap while still leveraging gold as a valuable asset. In conclusion, the gold market is no longer a straightforward reflection of supply, demand, or economic risk. It is a complex system influenced by central banks, futures markets, ETFs, derivatives, algorithmic trading, and geopolitical strategies. For investors and nations alike, understanding these hidden forces is essential to protect wealth and avoid falling into the trap of artificially manipulated prices. Gold remains valuable, but only when approached with knowledge, strategy, and a clear understanding of the risks involved. Thank you for watching this deep dive into the $6 trillion gold trap. If you found this video insightful, make sure to like this video, subscribe to our channel, and turn on the notification bell so you never miss an update on hidden truths about the global economy. Your awareness is the first step in navigating markets that are often far more complex than they appear. Stay informed, stay prepared, and protect your wealth.